Hey there, financial adventurers. Ever wonder what makes a stock hard to borrow and what that could potentially mean for its price action? Today, we're diving deep into LHSW International Group Limited, trading as LHSW, a fascinating microcap that recently popped up on our hard to borrow screener. We'll break down its unique situation, from its sky-high borrowing fees to its recent reverse stock split. Get ready to understand the mechanics behind a potential squeeze. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's zoom in on LHSW. LHSW International Group Limited operates in the technology and software infrastructure sector, primarily providing machine vision products and AI solutions in China. With a market capitalization of just $7.08 million, this is definitely a microcap stock. Looking at its recent price action, LHSW has seen some significant volatility. Today, it's up plus 6.67%, but over the last 5 trading days, it's down a substantial minus 30.43%, and over the past 30 days, it's dropped minus 18.92%. Volume-wise, today saw 68,712 shares traded, a sharp contrast to its 30-day average volume of 4,109,735 shares, giving it a relative volume of essentially Xerox average. Show chart, LHSW with price and volume data. This tells us current trading activity is significantly lower than its recent norm. What is cost to borrow and why it matters? So, what exactly is cost to borrow? When investors want to short sell a stock, they first have to borrow shares. The cost to borrow, or CTB, is the annualized fee short sellers pay to loan those shares. Think of it like interest on a loan. A high CTB is crucial because it signals one of two things, or often both. Either there's extremely high demand to short the stock, or there's a very limited supply of shares available to borrow. When CTB fees climb into the hundreds or even thousands of percentages annually, it means holding a short position becomes incredibly expensive, day after day. This pressure can force short sellers to cover their positions, buying back shares to avoid accumulating further fees. Why the stock is hard to borrow right now. Now let's look at why LHSW is appearing on our hard to borrow screen. The annualized cost to borrow fee for LHSW International Group Limited currently stands at a staggering 639.9%. That's an extremely high rate. Furthermore, its CTB momentum has dropped by minus 127 percentage points over the last 5 trading days, meaning it was even higher recently, indicating intense pressure. The number of shares currently available to borrow is incredibly low, at just 9,000 shares against an estimated flow of 1.0 million shares. This tiny borrowable supply combined with the exorbitant fee is precisely what makes LHSW a hard to borrow stock. Our internal composite squeeze score, which combines these factors with price momentum and technical setup, currently sits at 40.0 for LHSW. Highlight CTB, borrower supply, float numbers. Squeeze mechanics explained. So, what happens if a stock like LHSW starts to see significant buying pressure? This is where the short squeeze mechanics come into play. When a stock's price begins to rise, short sellers face increasing paper losses. Coupled with the crushing cost to borrow fees, they can be forced to buy back shares to close their short positions. This buying action, driven by short covering, further pushes the price up, triggering more short sellers to cover, creating a cascading effect. This rapid buying frenzy is what we call a short squeeze. Dilution risk check. One critical factor we always examine is dilution risk. Dilution occurs when a company issues new shares, which increases the total share count and can reduce the value of existing shares. Even with a high cost to borrow, dilution can significantly offset or even negate a short squeeze thesis. For LHSW, our check found no recent dilutive SEC filings such as -1s, -3s, or 424 BS in the last 90 days. This is generally a positive sign, indicating that the company hasn't recently undertaken actions that would directly expand the share count and dilute existing shareholders. Recent reverse split watch. Another important piece of information for LHSW is its recent reverse stock split. LHSW International Group Limited executed a 1/4-16 reverse stock split on 20/26/6/22, which was 24 days ago. A reverse split reduces the total number of outstanding shares and, in turn, reduces the float, while resetting the share price higher. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse stock split. While this is a pattern observed in some microcap names, it's crucial to understand it is not a guarantee for LHSW. Especially given its minus 30.43% drop over the last 5 days, the pop is far from certain, but the reduced float can make it more susceptible to large price swings and relatively low volume. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For LHSW, given its current hard-to-borrow status, there are several things to watch. First, keep an eye on the borrower's supply. 9,000 shares is incredibly low. Any further decrease could intensify the pressure on short sellers. Second, monitor their colossal 639.9% cost to borrow fee. If this climbs even higher, it dramatically increases the daily cost of being short. However, remember that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have strong conviction in their bearish thesis and are willing to pay a premium to stay short. The extremely low relative volume also means that even moderate buying pressure could lead to significant price movements. Linus Oil International Group Limited, LHSW, presents a compelling case study in hard-to-borrow dynamics due to its extremely high cost-to-borrow fee, minuscule borrowable share supply, and small float, all occurring in the wake of a recent reverse stock split. While these conditions create the theoretical setup for a short squeeze, always remember that investing carries risks, and market outcomes are never guaranteed. Stay informed, do your research, and understand the risks involved. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth analyses, and let us know your thoughts or questions about LHSW in the comments below.